How's it going, everyone? Welcome back to the Crunching Numbers YouTube channel. Today we'll be taking a look at the consolidation method within accounting, which is used for acquisitions, i.e. when a parent company purchases over, say, 50% of the voting stock within another company. So whether you're studying for the FAR CPA exam or you're taking an intermediate accounting class, then this is definitely the video for you. Now, later on in the video, I'll be going over some examples having to do with the consolidation method. If you just want to skip right to those examples, I'll leave them in the timestamps below for you. But before that, I'll be giving a brief overview of what the consolidation method is and when exactly to use that method. So that being said, let's get right into it. What exactly is this consolidation method? Well, it's used to account for a parent company's investment within another company, i.e. the subsidiary. Now, when exactly to use this method? Well, the parent company needs to own more than 50% of the subsidiary's voting stock. So if you take a look at the graphic that I have right below that, typically when a parent company purchases, say, in between 0% to 20% of another company, they would be using the fair value method. Anywhere between 20% to 50%, typically they would be using the equity method, which I actually made a video on that a couple days ago. I'll leave that somewhere on the screen if you want to check that out. But if they use any of these two methods, you're not going to consolidate. However, if they purchase, say, anywhere between 50% to 100% of another company, that's when you know you're using the consolidation method. Now, just real quick, when you're not using the consolidation method, say the subsidiary is either filing for bankruptcy or they're in some sort of legal reorganization, or, of course, if the parent company owns less than 50% of those voting shares. Now, just keep in mind, under the consolidation method, the parent company is essentially consolidating their financial statements with the sub. A large portion of what surrounds this consolidation method is that of eliminating journal entries in order to do this consolidation, which we'll be taking a look later on in the video. And again, just keep in mind, only the parent company would consolidate, not the subsidiary. Next, quickly taking a look at some of the journal entries having to do with the consolidation method. Again, just keep in mind, if you know how to solve for these journal entries and if you know the exact journal entries themselves, you should be able to answer a majority of the questions that are being asked under the consolidation method. So to start off with, to account for the initial investment within that company, again, this is the same for any of the three methods that I had listed on the previous graphic for you, either the fair value method, equity method, or of course this consolidation method. What you would want to do is debit investment in the subsidiary account, therefore raising that account, or credit cash if you're purchasing that investment for cash, or credit common stock, or any additional paid-in capital if you're issuing stock to make that purchased. Next, taking a look at our eliminating entry upon consolidation. Again, this is a key concept in understanding the consolidation method. Basically, the parent company will want to make these journal entries at the end of the year in order to consolidate their financial statements with the subsidiary. Now, in order to do that, they're going to want to remove the common stock of the sub, the additional paid-in capital of the sub, and any retained earnings of the sub, therefore debiting those accounts and remove them off the books. They're going to want to credit their investment in subsidiary account, as well as credit their non-controlling interest, say if they didn't purchase the subsidiary at 100%. And they're going to want to debit out their fair value balance sheet adjustment, intangible asset adjustment, and any goodwill related to that purchase. Again, the fair value adjustment and the intangible asset adjustment might be a little confusing just being described to you, but we're going to take a look at some examples later on in the video that hopefully clarifies that up. Now, taking a look at our first example here, very simple consolidation method problem. On January 1, year 1, Blue Company purchased 70% of Red Company for $560,000. Now, Red Company properly accounted for this business combination as an acquisition. On this date, Red Company stockholders' equity had a book value equal to their fair value of $700,000. Now, quickly taking a look at what they're asking us to calculate. Number 1, the journal entry to record the initial investment in Red Company. 2, determine what amount should be allocated to non-controlling interest. And 3, the year-end consolidating work paper eliminating entry. Focusing on the first one here, the amount to record for the initial investment in Red Company. Well, reading the problem says Blue Company purchased 70% of Red Company, which as soon as you see a percentage over 50%, you should already be thinking consolidation method. And they purchased the 70% of Red Company for $560,000. Now again, if we just remember the journal entries on the previous slide, we should be able to answer a majority of these questions. So as we know, to record that initial investment, we would debit out investment in Red of $560,000 and credit cash, since we purchased investment for cash, of $560,000. Next, taking a look at determine what amount should be allocated to non-controlling interest. Basically, what we're going to want to do here is find the implied fair value of Red Company if Blue Company were to purchase 100% of Red Company. Now, in order to do that, all we have to do is take our investment in Red of $560,000, divide out our ownership percentage of 70% to get our implied fair value of Red of $800,000. Remember, this number just represents if Blue Company were to purchase 100% of Red Company. So we have our implied fair value of Red of $800,000, and we're going to want to multiply it by the non-controlling interest percentage. Again, this is just 1 minus the ownership percentage at 30%. So we take our implied fair value at $800,000 times our non-controlling interest percentage at 30%, and we get $240,000 being allocated to non-controlling interest. We could also solve for this by just taking our implied fair value of Red Company at $800,000 and just subtracting out our investment in Red Company of $560,000, which leaves us with the same answer of $240,000 being allocated to non-controlling interest. Next, we're going to want to figure out the year-end consolidating work paper eliminating entry. And in the problem, it also gives us that Red Company stockholders' equity had a book value equal to their fair value of $700,000. Now, whenever you see a number associated with the book value of, say, the subsidiary stockholders' equity, or sometimes they may give you the stockholder or subsidiary's net assets, we're going to want to associate that number with the subsidiary's common stock, additional paid-in capital, and retained earnings accounts. So as we know from the previous slide when reviewing the journal entries, that's the first thing we're going to want to eliminate when consolidating. So we're going to debit out the common stock of the sub, the additional paid capital of the sub, and the retained earnings of the sub at $700,000. Again, if the problem doesn't break out the individual numbers for you, you can just put one number for all these three accounts. Again, we're going to want to credit out our investment in subsidiary account, which we already figured out to be $560,000, and credit out the non-controlling portion of that of $240,000. And finally, we know we're going to want to debit out any fair value balance sheet adjustments or any intangible asset adjustments. However, in the problem, it gives us that Red Company stockholders' equity had a book value equal to their fair value. So when these numbers equal, you're not going to need any adjustments. So you can put 0 for both those accounts. However, it's going to want us to debit goodwill. So in order to solve for that, we're going to take the implied fair value of Red Company again at $800,000, and we're going to want to use the fair value of the stockholders' equity or the subsidiary's net assets, which again, it said book value equaled fair value at $700,000. So we net these two together, leaving us with $100,000 left for goodwill, which we're going to want to debit that out. Next, taking a look at our second example here, having to deal with fair value differences. On January 1, Year 1, Green Company purchased 60% of the voting stock of Yellow Company for $180,000. The fair value of this investment is equated to $300,000, and non-controlling interest is $120,000. Sometimes you'll come across problems that automatically give you the implied fair value as well as the non-controlling interest. On this date, Yellow Company's net assets had a book value of $220,000 and a fair value of $240,000. A portion of this difference is attributed to a patent with a fair value of $5,000 over its book value. Now let's take a look at what it's asking us to calculate. 1. The journal entry to record the initial investment in Yellow Company. 2. Determine the amounts allocated to the fair value balance sheet adjustment as well as the intangible asset adjustment. And 3. The year-end consolidating work paper eliminating entry. Focusing on the first question, to record the initial investment, again, this is just remembering journal entries. It gives us in the problem that Green Company purchased 60% of the voting stock, which anything over 50, or anything consolidation method, voting stock of Yellow Company for $180,000. So taking a look at our solution here, we know we're going to debit investment in Yellow for $180,000 and credit out cash since we purchased this investment for cash of $180,000 as well. Number 2, determine the amounts allocated to the fair value balance sheet adjustment and intangible asset adjustment. Well, in the problem, it also gives us that Yellow Company's net assets had a book value of $220,000, but a fair value of $240,000. So to initially solve for these amounts, what we're going to want to do is to find out the fair value difference. And all we do to solve for that is the fair value of Yellow's net assets, which again, they gave us of $240,000. Subtract out the book value of Yellow's net assets of $220,000 to find the total fair value difference. However, a portion of this is going to be given to the fair value balance sheet adjustment, and a portion is going to be given to the intangible asset adjustment. In order to figure this out, we're going to take a look at our problem, which gives us that a portion of this difference is attributed to a patent with a fair value of $5,000 over its book value. So again, taking a look at our solution, we're going to take the total of the fair value difference, subtract out the portion that's being given to the intangible asset adjustment, which is being given to that patent because patents are intangible assets, which leaves us $15,000, which is going to be the portion of fair value balance sheet adjustment. Now finally, taking a look at the last question here, the year-end consolidating work paper eliminating entry. Well, just like in the last problem, we're going to find out Yellow Company's net assets had a book value of $200,000, which we know is being allocated to the subsidiary's common stock, as well as additional paid-in capital, as well as the retained earnings amounts. So if we take a look at our solution here, We're going to debit out common stock of the subsidiary, the additional paid capital of the subsidiary, as well as the retained earnings of the subsidiary for $220,000, or the subsidiary's net book value net assets. Next, we're going to want to credit out our investment in the subsidiary, which we know to be $180,000, which is given in the problem, as well as credit out the non-controlling interest portion of $120,000, which is also given in the problem. Next, we're going to want to debit out our fair value balance sheet adjustment, which we already solved to be $15,000, and debit out our intangible asset adjustment, which we already solved as well to be $5,000, which is also given in the problem. Finally, it wants us to remove goodwill, which is all we're going to do, like in the last example, take the implied fair value of yellow, which is given in the problem at $300,000, and subtract out the fair value of yellow's net assets of $240,000, which leaves us with goodwill of $60,000. So we would debit goodwill $60,000. Finally, taking a look at our last example here, what to do if you have a gain on a transaction. On January 1, year 1, Pink Company issued 10,000 shares of $1 par value common stock with a fair value of $35,000 for 80% of the outstanding shares of Gray Company. At the date of acquisition, Gray Company's net assets had a book value of $30,000 and a fair value of $45,000. Quickly taking a look at what they're asking us to calculate. 1. Journal entry to record the initial investment in Gray Company. 2. Amount of gain recognized in this acquisition. And 3. Year-end consolidating work paper eliminating entry. Well, focus on number 1 here to record the initial investment. It says they issued common stock with a fair value of $35,000 for 80%, which again, anything over 50, we already know consolidation method, of the outstanding shares of Gray Company. So again, remembering journal entries, we already know that we're going to debit the investment in Gray Company for the fair value being given up for this investment at $35,000. Credit out common stock since we're issuing stock to purchase this investment, and we issued 10,000 shares at $1 par, so 10,000 for common stock, and any additional would be allocated to the additional paid in capital account of $25,000. So number 2, amount of gain recognized in this acquisition. Well, the problem gives us that Gray Company's net assets had a book value of $30,000 and a fair value of $45,000, which we already know typically to find out goodwill allocated to a parent company over a subsidiary company is taking the implied fair value of that company and subtracting out the fair value of their net assets. So taking a look at the solution here, we're going to figure out our implied fair value by taking our investment in Gray Company of $35,000, dividing it by our ownership percentage of 80% to get our implied fair value of Gray Company at $43,750. Now to calculate the goodwill or the gain, we're going to take the implied fair value of Gray at $43,750 and subtract out the fair value of Gray's net assets. Now in this problem, the fair value of Gray's net assets is actually in excess of the implied fair value, which results in negative $1,250, or a gain. So whenever this number is a positive or the implied fair value is over the fair value of Gray's net assets, you're going to be using goodwill. However, if the fair value of the subsidiary's net assets is in excess of the implied fair value of that subsidiary, that's how you know you have a gain. Anyway, moving on to the third question here, the year-end consolidating work paper eliminating entry. Again, looking back at our problem, it says Gray Company's net assets had a book value of $30,000, which we already know the net assets of the book value net assets of the subsidiary is allocated to their common stock, additional paid in capital, and retained earnings account. And that's our first step in the eliminating journal entry. Debit out common stock of the sub, debit out additional paid capital of the sub, and debit out retained earnings of the sub at $30,000. Next, we're going to want to credit out investment in subsidiary to remove that at $35,000. And we're going to want to find out the non-controlling interest portion in order to remove that. Again, in order to do that, we're going to take our implied fair value of Gray Company at $43,750. Just subtract out your investment in Gray at $35,000, which leaves us at $8,750, which is the portion allocated to non-controlling interest. So credit non-controlling interest, $8,750. Next, we're going to want to figure out the fair value balance sheet adjustment. And just like in the previous example, in order to do that, we take the fair value of Gray's net assets, which is given in the problem at $45,000, and subtract out the book value of Gray's net assets, which is $30,000, and we get our fair value difference of $15,000. So we would allocate $15,000 to the fair value balance sheet adjustment. Again, intangible asset adjustment would just be 0 because nothing's given in the problem about intangible assets. And we're going to debit out the gain of $1,250, which we calculated in the second question in this example. Again, if it's goodwill, we're going to be debiting that out. However, it's a gain, we're going to want to credit that out. And that pretty much wraps up the basics surrounding the consolidation method of accounting. Again, if you're able to understand the examples laid out in this video and come to the correct answers on your own, then you should be able to solve a majority of your questions in your homework assignments and even on your exams. In my next video, I'll be going over some advanced concepts and advanced questions surrounding the consolidation method, so be sure to check that out. Anyway, I'll leave you with a question of the video, which is, what are the steps to determine non-controlling interest in example number 2? If you remember, within that example, it actually gave us the amount of non-controlling interest in the problem, and we went over the steps on how to determine non-controlling interest in example number 1, but see if you can lay out the steps in the comment section below, and remember the first comment I see will be pinned. Also in the comment section below, please say what concepts you want me to make a video on next, or what other videos you would like me to make. With that being said, I hope you enjoyed this video, and I hope everyone has a good one.